We have another tradition. I think we're on week 77. Stephen Burke, I'm going to ask you to come up, and this great panel, you can stay if you want. He always tells us something that's, what's happening in the markets, macro. But he usually tells me what he's going to talk about. But now, I have no idea what you're going to talk about, but I know it'll be good.
So, okay. I got a text on the way in today, or when I walked into the room today, asking if I could say something at 11 o'clock. So, completely unprepared. One of the suggestions from Mark is about business coming to the Midwest. So I'm going to steal something from Nancy Lazard, Cornerstone Macro, who has has a view that the U.S. might be the best, the Midwest might be the best emerging market in the world. And why would that be? Well, obviously, as we've seen from the tour, it's pretty clear that there's a lot of really good stuff going on. But I think from an economic perspective, it goes back to, as Ed was talking about yesterday, the cost of living wage increases that were guaranteed in union contracts in the 70s started to push our manufacturing capabilities to an uncompetitive state, while China at that same time is really starting to take off, and that allowed the shift over to China. Fast forward 30 years, China is now less competitive themselves, and that's actually pushing manufacturing elsewhere. Throw into that, we have supply chain disruptions starting from when President Trump started pushing China on that, and that's created on trade tensions. That created a whole reorientation of supply chains, and when we've started looking at it now, we're bringing them closer to home, making them more resilient, and we're doing it with more just-in-time stuff because companies don't want to be completely tied into just running low inventories and being dependent on the whims of the whole production chain, which is undergoing a massive transformation right now. Add to that, you have the work from home and climate change, which are giving people the options to work in different areas and from the work at home, and it's shifting people from the coast into the Midwest because of the climate change issues. You have great cost of living going on here, as we've seen in the Midwest. You have a large labor force that can be put to work, and I think more will stay home when the benefits of the cost of living really plays through. And you add to that, you have really nice people in the area, which makes it a better place to do business as well. So I think there's a lot of reasons why it's coming back. I also think there are some things that are going on that we don't focus on as much. There is a lot of regulatory certainty in the U.S., even though we have the political wrangling in Washington, D.C. and all that. And what you've seen in China, I think they've put in 155 regulatory changes since the start of the year, and they weren't minor. And that creates a sense of where do you want your rule of law to play through? How do you want to build your business around models that you have less certainty on? And I think we're in an environment where you're pushing for more certainty, which is going to bring more business back to the U.S. I think the other thing that's going on is the manufacturing sector is going through a massive technology transformation that will require a little bit less on labor and more on the technology stacks that are going up, which is going to further enhance the ability for us to compete. And when you do that at the same time, I think China's wages went from, say in 2000, just under 5,000 on a per capita GDP basis, not wages, but per capita GDP, shifted up towards closer to $10,000. And as they're trying to move up the value chain in technology and manufacturing, it's going to be harder for them to be cost competitive. And you're already starting to see that with Thailand, Cambodia, and other countries seeing production shift there. We think there's going to be a continued push for finding lowest cost of opportunity to manufacture, but also with the highest quality. And I think that also is another benefit of bringing things back to the U.S. So I think from those perspectives, I think there's a really interesting thing going on. It's occurred over a long period of time. And when we have these transitions, it happens very quickly. I'll also add to that, when we started really losing competitiveness in the manufacturing sector, and even up until President Trump lowered taxes from the corporate side, we were at about 35% corporate taxes, and the OECD average was around 25%. So why we're going back above 25%, because I think it's still there right now, and trying to be less competitive is something that you can scratch your heads at with the DC crowd, but I think they're not really clear on what competitive advantages are and even just moderating the disadvantages. So I think it'd be interesting to see if Manchin wins and we get it back to 25%, or if it's even 26.5 is not the end of the world. But I think that tax change also made us a lot less attractive back then and more attractive now. And if we don't blow it with the next tax changes, I think that's going to be another thing that'll keep us in a competitive state. So with that, I'm happy to take any questions. That was not something I was prepared for today. Excellent. I'm sorry, Barry, go ahead.
I just want to discuss inflation for a minute.
Great. So that's, I was going to be my other topic, so I was...
You were prepared for that?
I was prepared for that. Listen, I think the way the markets work and the way the news works is it always seems that the time we're talking about it getting worse is it's already gotten to the peak. So I remember when I was early in my career, I had a chance to work with, for those old enough to remember Louis Rukeyser on Wall Street Week, he had a guest on regularly called Monty Gordon from Dreyfus, and Monty was a very sage wisdom guy for investors. He had been through the wars, and he told me one day that he was working for Beige Securities, and the head of Beige Securities went out with the head of Ford and came back from the lunch and sold all the stock. He said, sell all the stock. And everyone was like, that was the largest position at the time. Why would you sell all the stock? So they were, who's going to go in and ask? So Monty went in and asked, and he said, what's wrong with Ford? And he said, nothing. The CEO told me things are going to get any better, so they're only going to get worse. So sell the stock. So he jumped out of the stock, and that was actually true at the time. The stock cratered right after that. I think the same thing applies in reverse. When you think things can't get any worse, it's probably already in the news, and we're starting to see changes. And I was talking to Matt Friedman last night, and he was talking about what he's seeing from the auto industry, which is one of the areas that you're starting to see this, and he thinks we're starting to see the easing already. You look at a lot of different prices, lumber and others, that are already starting to come down. So I think I think we're starting to see the transition going. Some of it, Powell was out today saying it's more persistent than he thought, but what is transitory is the definition like, is. I think from the old days, nobody's really defined it, so we have to figure out what it's going to be. Transitory it just means it's not permanent, right? So it can take more than a couple quarters to see that work through. And you're starting to see rolling things going on where you're seeing certain areas come down and other areas accelerating, like energy today and energy in Europe. So I think we have to think about the policies that are going against what's driving inflation. The climate change initiatives make all the sense in the world. The execution of them doesn't. As Ed was pointing out, you can't just wish something to happen if it's not backed up by the economics and the math and all that. And I think that's one of the areas we're starting to see some tension between affecting an appropriate climate change transition or not. And I think we're in right now, the strategy of doing it on a deadline as opposed to with a process is part of what's gumming up the works. But I suspect that the productivity changes that we're seeing, if you have higher inflation for even a little bit longer, will force companies to be more productive because they don't want to be cut in the bind, and that'll create the impetus behind improving the productivity, which will lower the inflation. So I think it's going to be a little more persistent. Powell and Janet Yellen were on talking to Congress today about the debt ceiling. Powell came up and said it was more persistent than he thought, but it still believes it's transitory. And the strategists that we follow most closely are still in that camp, but there is, you have to drive defensively as well. So it's easy to say it now. We'll have to see. I thought it would be less persistent than it's been already, but there's a lot of other dynamics going on. China disrupting things with the regulations, the European energy crisis, all those things work against it. I also think all those things work in favor of us bringing stuff back to the U.S. as well. So I think it's kind of all connected, and that's one of the things we've always felt is the interconnection and interdependencies of a global economy are a lot different than we had in the 70s. So we have to be more aware of that, but it looks like people are going to get somewhat a little more insular as well because of the geopolitical dynamics as well as the economic dynamics that are persisting today. So, I hope that helps.
Any more questions? Ideas?
Mark, we do have Phil brought his CIO, so I don't know
Yeah.
if he has something he wants to weigh in on any of
Please.
this stuff. Correct me, please.
Well, Stephen likes, if it happens to him, he wants it to happen to someone else. So you're on the spot now.
Sure, in front of the camera. Good call. Great. My name is Mike Parker. I'm CIO of SWS Partners. Joined SWS in 2017 after spinning out of Ohio PERS, one of the big state pensions here in Columbus. Right now it's a $120 billion fund. I was there on a team of 9 who managed public equity portfolios. So my perspectives, everyone likes to hype their asset class, so my bias is public. However, I think especially today we saw a lot of folks speak and saw a lot of the investments that are happening in Ohio. And you can no longer think in kind of the neat confines of your own market today, because innovation happens up and down the cap spectrum. And so I identified the opportunity to basically take the DNA of the team I worked on that was managing public equity portfolios at Ohio PERS and kind of look at it with a clean sheet of paper. And so I spun out of there in 2017 and convinced one of my colleagues to join me there. And today we basically address high net worth family office, but also large institutions as well in the same house. So we just crossed our 3-year track record after getting our flagship strategy off the ground in 2018. And a lot of things I see eye to eye with some of the things we talked about today was a lot of these data centers that are being built by these large public companies. You kind of think about, 10 years ago, the gatekeepers of CapEx were the guys that were, building silicon chips, the guys that were building wireless towers, spending $10+ billion a year to build out these infrastructures. And you think today, a lot of these gatekeepers are Facebook, Microsoft, Amazon. Those guys easily spend $20 billion plus a year. And they enable folks, that the innovators, the entrepreneurs today, to say, hey, look, if I kind of viewed compute intensity as a utility, what things could I build on top of that? And so no longer do you have to kind of think about a budget that's tens or hundreds of millions of dollars to go build a compute architecture. You can basically swipe it with a credit card today and rent it, not just the compute hour, but the compute millisecond for pennies on the dollar. So basically that's enabling a whole slew of businesses in the private markets as well as the public markets. And as a manager of public capital, I see it as my job to sort of not be concerned with how its equity is priced, whether it's in the public markets, and today's a great example of some volatility that flows can entail, but understand how entrepreneurs and executives are steering capital to go in pursuit of economic return and economic value creation. So yeah, you just kind of think about, some of the things that we enjoy today, like you think about your home broadband speed, right? In 2013, that was back when healthcare.gov was the big kind of initiative that was trying to get off the ground and think about, enrolling millions of people simultaneously. I think average broadband speeds then were 15 megabits per second to the home. And you think about today, we're broadcasting live on Zoom without issue, and broadband speeds are very different today. So you have whole new businesses that could be created that just 7 years ago failed miserably when it had to go from zero activity to millions. Now, you have multiple millions of people that's basically broadcasting via video. That's all being enabled by these corporations that are steering capital to build these infrastructures that entrepreneurs can build on top of. So I'm concerned about some of the things we talked about. Inflation, that's something to pay attention to. There's some bubbles that form in our markets as well. I was just looking at my list of 120 SPAC companies today. There used to be a time we talked about unicorns in aggregate were the size of Microsoft at the time. Today, you think about the SPACs, and that 120 list I have is about 250 billion in market cap itself. You're gonna have some bad actors in there for sure, but there's definitely gonna be some diamonds in the rough to pay attention to. So it's our job as public investors to sort of dig into these companies, get very granular, may have to get some confidence with investing pre-revenue, because whether we like it or not, the artifacts are going to manifest themselves in the public markets. So it's just, as a public investor, you just got to up your game. You have to go deep, you have to go granular, and you have to kind of be focused on the next 3, 5, 10 years of how this is all developing. So I know one of the questions that Mark presents is sort of what gets you excited about the the future of your space. And for me, it's like I said, if you could treat your compute intensity as a utility, what cool things could you build on top of that? And that's happening left and right across the public equity market cap spectrum. You just have to be a lot more discerning. You have to do a lot harder work. Kind of the DNA that we borrowed from running money inside of a $120 billion pension, we're now doing here for high net worth family office and other institutions as well. So just a little bit of taste there. You had a question? Yeah, what's scary is it's, data is kind of becoming, is basically the enabler. It's sort of what you're doing with your own data, the insights you're extracting from it. And, I look at the tools I use at my desk and my phone today, and these are basically tools that, the most sophisticated investors would pay millions of dollars to get access to 5 or 10 years ago. So there's sort of this, democratization of these tools that basically any information I want is at my fingertips. So it's upped your game in terms of having to kind of drink out of the fire hose and make sense of it. The perception is that that's messy and that's hard to find, insights and hard to find an edge. But the reality is that, again, you can kind of, see where this is all going, develop a thesis, and the key thing is just not to take the head fake, because the head fake's coming, and it's coming in higher frequency. It's coming, with just, higher swings today. But the underlying goal, like I said, is trying to basically create economic value with incremental allocations of capital and generating a cash flow off that capital. So it's my job to figure out what the price of that will be 3 or 5 years from now. But yeah, it's just sort of lifting the floodgates essentially on every source of information that previously you kind of had to have proprietary sources for. So.
Mark, I just wanted to add one thing on the inflation discussion because it gets lost. When we're growing at 6%, 5%, whatever it is this year, and inflation's growing at 3%, if you keep a ratio like that, you can live with a little inflation, because what's going to happen is, and this is part of the job you were talking about digging in, some people are going to benefit from this big. Companies who can pass on pricing in this environment are going to see higher earnings and higher revenues that are going to come back to them and in a big benefit. The other side of it is higher wages flow through to higher consumer spending, which actually continues to improve the economy too. It also improves their net worth. So you have to look at it in the context of what's the rate of growth versus the rate of inflation as well. And if we were running at the growth rates we had been pre-COVID, that would be a real issue, seeing this spike up. When it's somewhat a positive delta on it, it makes it a little bit more less of a concern if you can keep that element of it. So I think that's an important part. And the last thing I'd say about innovation, when we were in this tour and I hear all the stuff you guys are doing with these new technologies, new businesses, new ways of thinking about it, it is that innovation that's going to drive this economy forward, and it's what gives me the excitement and the hope about what's ahead of us, as opposed to the fears about whether Washington screws everything up or whether, we have all these other issues. I think if we continue to innovate the way with the businesses like you guys are doing, there is no stop to what this economy can do. So I think that's the issue. And a lot of these are anti-inflationary technologies that you're developing. I think that's the other thing, that one of the takeaways that I have as I leave this event and all the different cities we've been in, and where we're going in Cleveland today to see the innovation that's up there. And that's what's the productivity improvements are the antidote to inflation. And if we continue to be productive and continue to innovate, we can manage the inflation issues if we have reasonable policies behind that. So I'll stop there.
Sure, great question. And then for the webcast, going from an asset owner to an investor, just from the pension to where we're now at SWS. I joined PERS when Lehman was going bankrupt. So the financial crisis was pretty much my first week in 2008. And it kind of taught me the value of patience and stability in sort of your time horizon, right? So all the contagion that was happening, getting your arms around that, you kind of compare and contrast that to the endpoint they're trying to solve for today, which is how much precision can we get on, a virus that's going through mutations and stay ahead of that and answer that question. It allows you to kind of see through a lot of that and basically kind of look at the next 3 and 5 years out and beyond, because every board hires their management teams with that perspective of how they're going to innovate and basically drive shareholder returns. And so it pretty much allowed me to put myself at the same table as those allocators of capital in the companies that we invest in. So the time horizon sort of was a big benefit of thinking longer term, but also not having, a shoulder tap when volatility intra-month happens that you have to make a decision based upon a flow. So that entity when I was there was roughly $75, $80 billion, or $120 billion. They're basically trying to solve for a liability stream that is pension retirees payments across their lifespan. Every investor pretty much does that either implicitly or explicitly, and they're all trying to solve for a hurdle rate of return, somewhere in sort of the high single digits. At that entity, it's I think 7.75%. So every investor is trying to achieve a hurdle rate of return, but also needs some aspect of liquidity. And so it's very difficult to achieve that hurdle in fixed income and overnight rates. The interest rate environment just doesn't support it. So you have to kind of go higher risk, but you want some aspects of liquidity, and that's exactly what the public markets do. There is a huge pendulum shift, though, to just indexing right now. And what's really, really interesting is the context of that mass exit at the passive. We just crossed the parity point in 2019 when passive assets were roughly $4.8 trillion in the mutual fund and ETF market. They reached parity with active in 2019. They're still heading in that direction, but what it tells you is that everyone just sort of has given up on finding ideas and stock picking, to the tune of 4x trillion dollars that's invested in passive. And it really tells you that there's rocks to be unturned in the public markets. Like I said, it just requires a lot more work and a lot more sifting through noise. But those are aspects that I don't see going away, that I appreciate and borrow from that entity, and sort of thinking that same time horizon, the same perspective. So that kind of answer your question? Great. Sure.
Public and private. I know that there's a certain mindset. You guys had a ton of money to put to work, so the check size had to be, X amount. But just, I think particularly within this audience would be really interesting to hear your thoughts on larger versus smaller guys.
Absolutely. That's a great question, because that was a big part of, again, the clean sheet of paper of being able to build it on the outside without any biases. There is sort of this, kind of movement to sort of, as you scale with AUM, we need to be able to show our investors that we have scale via headcount. And what a lot of managers fail to do is they go and invest and populate their portfolios with very forward-thinking, very entrepreneurial mindsets, and then turn around and run their teams in the very opposite fashion. A lot of hierarchy, a lot of idea generation friction. The problem is with large institutions, sometimes you create unintended, sometimes intended, sort of friction points where if an analyst is trying to find an idea, meets with the management team, studies the S1, the company goes public, the ability to kind of have that view manifest itself in a portfolio position. There's a lot of things that can get dropped along that path. And so from our perspective, as we contemplate scaling our business to multi-billions of dollars in the future, we've thought through very careful ways to avoid a lot of those frictions. But the counter side of that is the resources you can get, the access you can get. It's just, you're able to up your game on the research side of things as well. So it's larger can very much, you don't see it as an investor with, I won't pick on the names, but the large guys that have trillions of dollars themselves, they pride themselves with pods of analysts who can give you granularity on any given company you want. But the reality of those granularities populating the portfolio and finding a portfolio manager who will listen to that person, there's just a lot of things that happen, balls that get dropped. And so there are definitely ways to run an asset management business where you just kind of create a horizontal structure and, again, ingest the portfolio ideas and then populate the portfolio with the best ideas across the entirety of the team. So, size can be helpful, but also it can be a detriment.
We got one more question.
One more back there.
Oh,
No?
Stretching out. Great. Thanks for your time.